A simple one ETF portfolio is enough to set yourself up for building some serious wealth in the future without making things overcomplicated. A one ETF portfolio is about keeping investing as simple as you possibly can. Rather than holding and managing multiple ETFs, needing to rebalance, or worrying about the performance of the different funds, you can choose one well-balanced and diversified fund to get the job done. For those who want to invest but don't have the experience, time, or interest to look into different ETFs to build a unique portfolio, a one ETF portfolio can be a great option. It's for people who want simplicity, automatic diversification, and a low-maintenance, long-term strategy. And the broad market ETFs that make up these one ETF portfolios give you exposure to hundreds of companies, or some even thousands of different companies worldwide, meaning one fund can essentially cover just about all of a long-term investor's needs. The fact that it's extremely straightforward also provides peace of mind, since there's less room for worrying or doubting if the portfolio is balanced enough. For many investors, especially beginners, this balance of simplicity and diversification is what helps to stay invested for the long run. I mentioned broad market ETFs, but what exactly does that mean? A broad market ETF is a type of ETF that lets you own a large slice of the stock market, with some funds being the whole entire market. And most broad market ETFs simply track well-known indexes such as the S&P 500, the total US market, or even the global market. So rather than picking individual stocks or combining multiple funds, you get instant exposure to hundreds or thousands of stocks spread across a variety of industries and sectors, which helps to lower risk compared to having exposure to just one part of the stock market or a handful of individual stocks. Because of this diversification of stocks, if some companies or sectors are struggling or performing badly, it can be offset by the strength in other holdings and sectors, which is especially important when we face economic downturns or bear markets. Throughout time, broad market ETFs have proven to offer a solid and strong historical track record of providing consistent long-term returns and growth through all types of market conditions. This doesn't mean that these ETFs are risk-free, since any stocks can carry some level of risk, but their diversified nature helps to balance and smooth things out compared to the more aggressive and concentrated strategies and funds. Now let's talk about the different broad market ETFs for each type of one ETF portfolio. So not only will we be talking about each ETF, but we'll also be comparing them against each other across a few different categories. First is going to be the strategy of these 4 ETFs so you understand exactly how they work. First up is going to be VU, the Vanguard S&P 500 ETF. This is the most popular ETF on the market today, and its strategy is simple. It tracks the S&P 500 index, which represents the 500 largest companies in the United States. And the S&P 500 represents about 80% of the total value of the US stock market, so these 500 companies play a huge part in the US stock market. Next up, we have VTI, the Vanguard Total Stock Market ETF. This fund tracks the performance of the crisp US Total Market Index, so it gives you exposure to large cap, mid cap, and small cap companies in the US, which includes thousands of stocks across a variety of sectors, with its purpose being that it exposes you to the entire US stock market, unlike the S&P 500, which is just those top 500 large cap companies. Third up, we have VT, the Vanguard Total World Stock ETF. VT tracks the performance of the FTSE Global All Cap Index, which means this ETF gives you exposure to the entire global stock market. So that includes small, mid, and large cap companies, not only in the US, but also in developed and emerging markets outside of the US. So you're invested in a wide range of companies in different countries all around the world. And the last fund to mention is going to be AOA, the iShares Core 80/20 Aggressive Allocation ETF. Now, this fund is quite different from the others since it's a portfolio that's not only made up of stocks, but also fixed income funds. This ETF offers a mix of both global stocks and bonds, so aims to be a more balanced portfolio. The addition of bonds can further reduce portfolio risk, as they're generally safer and less volatile than stocks, and they can also provide you with some income. Now that you see how each of these ETFs work, Let's see the differences between them and how they compare. This first category to compare is going to be diversification. So this will be the portfolio breakdown for these ETFs and how well diversified they are. For VU, this ETF has a total of 504 stocks with top holdings in familiar names like Nvidia, Microsoft, Apple, Amazon, Meta, Google, and more. And the top sectors VU is exposed to are technology, financials, consumer discretionary, communication, and the remaining spread in a few other sectors. So you can see while it does have a pretty nice balance over a variety of sectors, it's still a little bit heavy in tech. For VTI, this fund contains a total of 3,524 stocks, so quite a bump up from VU, and its top holdings are in companies like Nvidia, Microsoft, Apple, and others. It's essentially the same top holdings that you'd find in VU, except the percentages of these top stocks are a little lower than VU's. For the sectors VTI is mostly exposed to, you have technology up top, consumer discretionary, industrials, and financials. While it's similar to VU in the top holdings, overall there are a few percentage point differences for some of the sectors, and that's of course going to be due to all those additional holdings that VTI has. Moving on to VT, this fund contains 9,990 stocks in total, and its top holdings are in companies like Nvidia, Microsoft, Amazon, Broadcom, Taiwan Semiconductor, and more. So some of the same names that you see again here, but much smaller allocations in each, and the total percentage in the top 10 holdings are much smaller in VT. The sector exposure for VT mainly lies in technology, financials, industrials, and consumer discretionary. You can also see it's not exposed to as much tech as the others as well. And this is the breakdown by region, so North America makes up about 2/3 of the portfolio, and the remaining is spread out into Europe, Japan, and other regions. Last, we have AOA, which contains only 12 holdings in total, and that may seem odd, but this ETF is what you call a fund of funds. If we take a look at the top holdings, you'll see exactly what I mean. It invests in a variety of other iShares ETFs rather than stocks. So that's why you see IVV, an S&P 500 ETF, IDEV, an International Developing Market ETF, a bond ETF, small cap, and more. And it's mostly invested in the S&P 500, which makes up almost half of the portfolio. Then it has international stocks and bonds, as well as US bonds. So it's about 80% or so into stocks, and the remaining in fixed income and cash. And from a global standpoint, a majority of the exposure is to the US, but not overwhelmingly. So I'll be rating from a scale of 1 to 10, with 10 being the highest and 1 being the lowest. So when it comes to diversification, for VU, I'm going to have to give it a 7 out of 10. While the top 500 companies in the S&P 500 have had a huge sway in the US market, and while this has been a historically strong index, when it comes to really being diversified, it does fall a bit short. For VTI, I'll be giving this one an 8 because it's slightly more diversified than VU. While it does hold much more stocks than VU, it still leans heavily into those top stocks, and while it has small and mid-cap exposure that's quite small, it's still better than none at all. Next, for VT, I put this one at 9 or 10. This is simply because it gives you full exposure to the entire global stock market, so you avoid single country risk, which you really can't get better than that. And for someone who's younger or isn't looking to hold more conservative assets yet, this is going to be a 10 in diversification. Now, AOA on the other hand is going to be a 10 for sure. While bonds might not be relevant for you depending on where you are on your investing journey, having a mixed variety of assets of both domestic and international in one fund makes it very convenient and highly diversified. Getting to the good stuff, we have performance up next. Kicking it off with VU, this fund has been crushing it with annual returns of around 16.5% in the last 5 years and just over 15% annually in the last 10 years. And zooming out to the bigger picture from the last 30 years, the S&P 500 has provided some great returns over the long term through fluctuations of the market. Along with that, VU has a dividend yield of 1.15%, so nothing crazy here, but some dividend income is better than none. For VTI, this fund is close behind with annual returns of 15.6% in the last 5 years and slightly over 14.5% annually in the last 10 years. Like I mentioned in the last section, this fund is pretty similar to VU. If we compare the last few years to VU's performance, you can see their returns are pretty close to each other. And that's because the top stocks that it has, which are similar to VU, are really what's driving the performance. For the dividends, VTI is about the same as VU, with a dividend yield of 1.14%. Next is VT. This ETF has annual returns of about 13.5% in the last 5 years and nearly 12% annually in the past 10 years. These are solid returns, and it should be expected that it falls a bit shorter than the other funds, as those are a bit more concentrated and less diversified. It also has a dividend yield of 1.7%, which is paid quarterly, so a bit higher here. Then for AOA, this fund has 5-year annual returns of 11% and 10-year annual returns of 8.4%. Since this fund is structured to maximize balance and diversification, there is a trade-off in potential returns here for that added safety net that this ETF provides. And the dividend yield for AOA is 2.1%, which is the highest thanks to the fixed income holdings giving it a bump. And here's a chart comparing the performance of all 4 funds over the last 10 years. A few extra percent of higher growth compounding years down the line make a big difference. So when it comes to the performance, I'm going to be giving a 5 out of 10 for AOA. Because of its more conservative nature, this fund optimizes having a better balanced portfolio, so it's not going to be a top performer, nor should investors who seek out a fund like this should expect that. For VT, I'll be giving it a 6, again for the very same reason. While it doesn't hold fixed income, it's diversified across stocks globally, and if international markets aren't doing well, that'll play a big part in returns. And next, I'm giving a 7.5 for VTI and an 8 for VU. Since their returns are pretty close to each other, VU's focus solely on the S&P 500 gives it the slight edge here. And I didn't want to go beyond the 8 because a 9 and a 10 would be for a growth ETF or some focused sector or industry ETFs. This next category is volatility and risk. Since these ETFs are structured differently, I wanted to show you the differences between them when it comes to volatility and risk over the last 10 years. So we'll be going over the beta and the largest drawdowns that these ETFs experienced over the last decade. First, I want to go over beta, which is the measure of the risk or volatility of an investment compared to the market as a whole. And the S&P 500 is basically the market standard, so it has a value of 1. Anything above 1 is going to be more volatile and likely have more risk, while below 1 will be less volatile and less risky. Starting with VU, since it's the S&P 500, is going to have a beta of 1. Now, for the largest 3 drawdowns that VU experienced in the last 10 years, we have minus 23.9%, minus 19.6%, and minus 13.5%. For VTI, it has a 10-year beta of 1.03, and for the drawdowns, we have minus 24.8%, minus 20.8%, and 14.2%. Moving to VT, the beta is 0.94, and the drawdowns were negative 25.5%, 22.1%, and 14.4%. And last, AOA, the beta is 0.78, and the drawdowns were negative 23%, 18.1%, and 11.5%. When it comes to beta, you can see the more diverse portfolios, for the most part, are lower risk and have lower volatility. VTI is pretty close to matching VU, but it's a tiny bit higher due to those small and mid-cap stocks which it has exposure to, which tend to be more volatile than large-cap stocks, which play into those drawdowns as well. VT is lower due to the extra exposure of all the international stocks, but those drawdowns can be as large as VU's or more due to VT carrying small and mid caps from both US and international markets. Plus, you have to consider if international markets are getting roughed up at the same time as the US, that could amplify things as well. And AOA is much lower than all of them from the exposure to the stocks and bonds from both US and international markets, making it much more resilient, so to speak. That's why you'll also see the drawdowns being the lowest in the group as well. Because of this, AOA is going to get a 9 out of 10 here, VT will be an 8, and VU and VTI, I'll be giving a 7. There's no perfect 10 here since AOA is still mostly made up of stocks. Now let's talk about how each of these ETFs compare to each other across the 3 different categories. Ultimately, these funds aren't necessarily about being better than each other, as it's more so about what you're looking for as an investor based on your investing goals, your risk tolerance, and your age. If you have a long time horizon until retirement like me, then fixed income like bonds won't mean much to you, but it likely will for those on the other end. If you like the consistency and growth from the S&P 500 and you don't care much for the added exposure, VU can be a great choice. And the bonus here is that if you decide that you want to add international or mid and small cap stocks or anything else, you can control how much allocation you have rather than having a set percentage of US stocks, international stocks, or the amount of small or mid caps in a fund's portfolio. The same goes for VTI, as it's a slight extension to VU, with small and mid caps giving you exposure to the US market as a whole. And last, VT, which keeps it very simple and it gives you exposure to all the different market caps from stocks all over the world. Now, there's something very important to keep in mind when it comes to these funds, and that is there's no need to hold some or all of these types of ETFs. For example, holding VU and VTI doesn't serve any purpose at all, since VTI holds the S&P 500 stocks that you find in VU, so you aren't gaining any advantage here. Now, you may have the case where you have both a total US fund and an S&P 500 fund because of your 401k or other reasons outside of your control, and that's okay. But you shouldn't be actively choosing to buy both. The same goes for holding VU and VT. There's no need to double up on the same S&P 500 stocks. If you want to have more control of your allocations when it comes to diversifying, I think using a fund like VU or VTI as your base is one of the best approaches. Then, for example, if you want some international, you could add a fund like VX US and adjust how much exposure you want from there. This is where the limitations of a one ETF portfolio come into place. You lose out on that flexibility and ability to better customize your portfolio, since it might not truly be in line with your needs and goals. There could be certain sectors or industries that you'd like to have more exposure in, different asset types, a bit more dividends mixed in, or whatever the case may be. And one ETF might not be able to meet your needs if you start to have a more selective style in investing. But for those who want a simple and straightforward way to invest and be diversified, it's the way to go. For those that may want more control in their portfolio, a 3 ETF portfolio could be a great way to build wealth and stay diversified, which I talk about in this video here, or in this video here on the 4 ETF portfolio to enhance your diversification by even more. If you enjoyed the video, don't forget to like and subscribe for more content. Thanks for watching, and I'll be seeing you later.